With me now to discuss the state of the economy and what the future might hold is Diane Swonk. She's chief economist at Grant Thornton in Chicago. Diane, thank you very much indeed for joining us. So
great to be here.
This expansion is almost 10 years old. It's been getting stronger in the last year. We've had a year and a half or so of relatively strong growth. Why should we be concerned that it might be coming to an end?
Well, what we're starting to see is, recessions are one of those hard things to predict because you never know which straw on the camel's back is going to break the camel's back. But the pile of straws is starting to mount. And they're sort of an easy list to tick off that Lizanne sort of alluded to in many of her comments. One is the strong dollar, making it harder for our companies to export abroad. Weaker growth abroad, most notably China. People forget that even though we've got a lot of issues with China, China's the second largest economy in the world. It's a major market for Europe, Japan, and for the U.S. And as they soften, they have knockoff effects throughout almost every developed and developing economy in the world. And that's hard to capture in our models when we just look at these tariff wars. There's also, as you mentioned earlier, the ongoing struggle on tariffs, but disruptions it means to global supply chains and how that may work into price increases down the road, stagflationary kinds of pressures. We've got mounting corporate debt that the Federal Reserve and the OCC have sort of fired a warning shot above the bow of many banks now saying, listen, you're going covenant light here. We're worried about how much leverage is out there in the corporate sector. A lot of companies have extended and pretended in this low interest rate environment. And effectively, by the end of this year, we'll see a doubling of interest expense in 1 year because the Fed will do its fourth rate hike next week. The final issue, and I think it is the canary in the coal mine, is the weakness we've seen in housing. Never recovered from the crisis in many places prices, but volume did not recover from the crisis. And now we're starting to see a softening out there. The housing market can soften as much as a year and a half before the economy slips into recession, but it's already been going on 6 months that it's been weakening, and we are now down on both sales and actually starts from a year ago.
But the kind of imbalances that we do see as an expansion gets older, especially inflation, which often picks up, as demand is strong, with unemployment so low. We haven't really seen that, have we, this time around? So if the economy is going to be derailed, it's not going to be a sort of a typical pattern that we've seen in the past.
Exactly. As we often say, expansions don't die of old age. Usually the Fed kills them, and that certainly is something we've seen people worry about, the Fed killing the expansion. But in fact, what the Fed is doing now is, although they're going to raise rates one more time next week as they move in December, they're setting up time to pause because they are concerned about the slowdown in growth. And in fact, inflation hasn't flared. And that's been sort of a saving grace. It's warmed up a little bit, and they like the warming trend because it was too cool. This is now we've got an economy that's showing some level of heat and some heat on wages, which is something the Fed welcomes. But you have to think about the Fed as sort of your coach in a marathon. This is now a marathon of an expansion. Their goal has been to pace ourselves. As the economy accelerated in 2018, they wanted to make sure we didn't tire out too soon and not make it across the finish line.
Diane,
in 2019, they'll be trying to stretch that finish line out and make it longer.
The Fed's been raising rates for 3 years steadily, very steadily, quarter point at a time, 3 or 4 a year. So we're still at a relatively low overall level of rates. They're probably going to raise rates. Everybody expects them to raise rates again next week. After that, though, what should they do? What's next?
Well, I have only 2 rate hikes in 2019, and I am expecting a recession in early 2020, actually, with the economy weakening quite significantly in the fourth quarter of 2019, which may actually prompt the Fed to reverse course and start lowering rates then. I think the Fed will be very quickly.
So even in 2019, as early as 2019?
Even
2019.
As early as the end, a year from now, because if the economy, I do expect the unemployment rate, after edging all the way down to 3.4% by mid-2019, I think we're going to see it creep up a bit, and although that's still low, as we know, it doesn't include as many people from the sidelines as we once liked, and it hasn't produced the kind of wage gains that we'd like to see in more broad-based gains. We're starting to see some of that traction. You certainly want the expansion to go on as long as possible, and the Fed will be much more cautious in how they tread in 2019.